All right, hello everyone. Welcome to the final video for chapter 5. In this group of exclusions, we are going to be focusing on exclusion provisions related to sicknesses and injuries. And then at the very end, we're going to touch briefly on some deferral provisions. So just as that reminder to keep reiterating, because it's always good to hear something over and over, if income is excluded, what that means is that income will never have to be taxed. Whereas if income is deferred, that means that income will be taxed eventually. It just won't be taxed in the current year. The taxation will happen sometime later. So to start our discussion for sickness and injury related exclusions, several of these exclusions exist to help taxpayers that are sick and injured, because by having these exclusions, it reflects their inability to pay the tax. So that's why they're there, because if someone is sick or they're injured, they potentially might not be able to work in order to pay the tax on their income. And so then these exclusions ideally are supposed to help facilitate the recovery, because then if we're trying to help the taxpayers out and not requiring them to pay tax on certain things, hopefully once they are able to overcome their sickness or their injury, they can return and become a productive member of society once more. So the first type of payment that someone could receive related to sickness or injury is workers' comp. So payments from workers' compensation plans are excluded from gross income. So workers' compensation is excluded. It is important to note here that workers' compensation is different from unemployment compensation. And it's important to know that distinction because unemployment compensation is taxable. So unemployment compensation is taxable. So it's important to remember that distinction there. All right, other types of income related to sickness and injury. Let's say you got a payment associated with a personal injury. So that usually comes in the form of you started a lawsuit, like let's say you used a product, you got injured, you sued the company that produced that product, you won, and you received an amount from that court case for your victory. So whenever that happens, the piece that is excluded from gross income is the amount of the award related to the physical injury or sickness, or the payments for the medical costs of treating the emotional distress. Those parts are excluded from gross income. Any other payments, including punitive damages, are fully taxable. And the reason why punitive damages are fully taxable is because they are intended to punish the person that did the wrong action rather than compensating the taxpayer for their injuries, like the awards that we talked about in the first bullet there. Other types of income that can have exclusion provisions related to sickness and injury is healthcare reimbursement. So, if a taxpayer is reimbursed by health and accident insurance policies for medical expenses paid by the taxpayer, those reimbursements are excluded from their gross income because they were using those payments to cover their medical expenses. All right, the last type of income related to sicknesses and injuries that can have an exclusion provision is disability insurance. So disability insurance is also referred to as wage replacement insurance. So I'll put that out here. So, also known as wage replacement insurance. Make that look like a U. There we go. So what disability or wage replacement insurance does is it pays the insured individual for wages lost when the individual misses work due to an injury or a disability. And whether or not the payments are excluded from gross income depends, sorry guys. It depends on how the insurance policy is being paid for. Sorry, I'll apologize again. I was thinking too fast and running my sentences together. So, if an individual purchases the disability insurance directly, any disability benefits are excluded from gross income. If the individual's employer purchases the disability insurance and the premiums are taxable compensation to the employee, then any disability benefits received are excluded from gross income. If the disability policy is paid for by the employer and it is considered a non-taxable fringe benefit to the employee, then the employee must include those disability benefits in their gross income. So from that perspective of the employer, just to kind of help with keeping it straight. So if it's taxable compensation to the employee, then the disability benefits are excluded. If it's from the individual's employer and it's considered a non-taxable benefit, So if it's non-taxable to the employee, then the employee must include disability benefits in their gross income. All right, we've made it to the end, and we're gonna wrap up with just kind of highlighting some different deferral provisions, and we'll get into some of these in a lot more detail in later chapters. So like we mentioned earlier, if income is deferred, that simply means that tax will be paid on that income, but it will be paid later. So it won't be paid in this current year. And examples of transactions that can create deferred income include things like installment sales, so something is being paid for over time. Like-kind exchanges, any involuntary conversions, and contributions to non-Roth qualified retirement accounts. All right, I appreciate you guys sticking with me. I know that was a lot of material in this chapter. I know there's a lot of math. I highly encourage you to look through the practice problems again if you have any questions or are maybe not totally solidified on some concepts, so that way you can feel prepared for our exam coming up soon. See you guys later.